of the market on page 2, equities that returned, energy down 12.2% during the quarter, and responsible for all of the downside of the market. You'll see fixed income. We know those results. We know what happened in the markets. The longer duration you had, the better. The higher quality you had, the better. But still a market in transition. As we go on to page 6 on the upper left-hand side, you can see we had a very muted return during the year, 2.4%. The individual managers and portfolios are shown on page 7. So over the last 5 years, domestic equity portfolios have provided an annualized rate of return of 19.1%. Our international equity, which we just have a new manager relatively recently, 7.8%. Fixed income, 9.3%. The composite at 8.5%, and the actuarial assumption at 4.9%. So while we have had an extremely strong market, it is not without challenges, especially for active managers. And the last thing I want to say is let's not project this forward. Markets will likely be very challenging going forward, which is why we've been spending so much time on reallocating the portfolio. The next few pages, I think page 10 is a great page to really give an idea of what drove the portfolio's returns. You'll see that during the quarter, and this is as of December 31, the components of the return, how the individual pieces combined to provide the 1.5% return. You can see that Loomis sales slightly negative, Double Line, which was positive, Hoisington positive, Dreyfus appreciation positive and strong, Delafield's not a contributor, Stevens a positive contributor, and then our international equity as the dollar increased versus other foreign currencies and reduced the returns that we realized in the U.S. If we go on to the individual fund sheets, starting on page 13, Loomis Sales Core Bond. This is a core fixed income portfolio, which means it's supposed to resemble the overall market, mostly investment grade. This was added during July of 2014. Remember that we had a single fixed income manager that we replaced with the 4 that we have right now, and as we look over the last quarter, down 32 basis points because they're investing mostly in corporate bonds, and as we saw during the fourth quarter of last year, anything with corporate risk or any energy exposure went down during the month. We look at over the longer term periods, the last 12 months, last 3 years, last 5 years, top quartile results versus other core bond managers. Now, a common theme that we have been developing recently is we want to be exposed to the market, but we also want to be diversified, and that's one of the reasons that we have 2 core managers now. That is Double Line is the second one. Again, also came in during July of 2014. While Loomis was negative slightly for the last quarter, you can see that this portfolio did keep pace, or was positive, and then over the last 3 months and last 12 months and last 3 years, positive and top quartile. There is no 5-year result for this fund because the firm was not in existence at that time. This is formed by Jeffrey Gundlach and a group of folks who left TCW 4.5 years ago to start their own new firm. Their portfolio combines very well with the Loomis sales, as evidenced by the last quarter, but also its risk factors are nice and offsetting. Our other new manager, Lord Abbott, is on page 15. Target allocation of 3%. This was funded just recently, fully funded, and it was selected January 12th. The results of this fund, when we're looking at the last 3 years and last 5 years, very risk-controlled, but also participating in the market's results. And again, this is below investment grade. So these are high-yield fixed income securities, and Lord Abbott does a fine job of analyzing each of those. And then Hoisington. Not really a lot that can be said about this that the returns don't speak to. Up 11% during the last quarter, 12 months up 33%. The only funds that outperformed this one are levered, meaning that they actually borrow money and invest 1 or 2 times amount of capital. We're not interested in this. This is volatile enough we'll give up those 13 slots that are higher on the last year to those levered funds because we want to have good active management. This group that manages this fund, last year, I think I mentioned last time I was here, 67 investors, economists on Wall Street at the beginning of 2014, all 67 polled by Bloomberg said interest rates were going to go higher. They were all wrong. You have two managers here, Hoisington and Double Line, who thought that rates could go lower last year, and were actually correct. Not many others did that. The next few pages are our equity portfolios, Dreyfus appreciation, ultra large cap, ultra high quality. This is lower risk than the market as evidenced by its beta on 3-year characteristic. Its 3-year beta versus the S&P 500 is 0.68, meaning that it is less than 70% as volatile as the market, and one of the reasons that we have them. Unfortunately, when you have a market going up 5 years in a row, this fund will reduce your overall performance. Delafield is, we're in the process of replacing Delafield. We will come with more data next month. And then Stevens, which is also a portfolio not performing as well as we would like it to, but these are investors who think a little bit more long-term than most small-cap investors. They have both valuation, growth metrics, and behavioral science to building their portfolios. And again, when markets have extremely good times, like the fourth quarter of last year, very abrupt change in the market, then some of their holdings don't do well. Big areas that they're investing in right now are network security, technology companies. It doesn't seem like we go more than a few days without a large-scale data breach affecting consumers throughout the United States and elsewhere, and that's one of their new holdings in the portfolio, or several new holdings in the portfolio. So we're watching them very, very carefully. We don't think it's the same situation as Delafield because their portfolio is more adaptive and moves faster than Delafield. And then Causeway is our international equity manager. Performance is difficult in international equities. I think that if you pay attention to the international financial press, you can see why it is difficult. Europe is beset with issues on the southern flank, on the eastern flank. Japan, with their demographic issues, also a tough place. But we want to be exposed to international equities, and one of the main reasons why is because they are historically cheap. Again, this is not an area that we're going to be investing a large portion of the fund's assets in, but from a diversification standpoint, we do like international equity. Happy to take any questions about the fourth quarter report. I think we're making a lot of good progress in a lot of areas. The fixed income portfolio work that we did last year paid off, and we're looking forward to repeating that type of success with the equity portfolio.
All right. Thank you, Doug. Any questions? Thank you very much.
Thank you.
Next item that we have is discussion on consideration of approval for additional asset allocation or changes to the portfolio fund managers. We did have a discussion in investment committee, and we've given direction with Doug, and we're going to come back and have another investment committee meeting next month to have further discussions before we make any decision on that. So there'll be no action there. Next item is ratifying the claims listings. Can I get a motion?
Second.
All in favor? Any opposed? Great. And then we have our financials. I did want to point out that we weren't able to get those in time to have them on the packet so we could do a presentation on that. And so we'll do that at the next meeting, do the presentation. But just wanted to make sure you had this in your, so you could review this, and then Mitchell will be here next week or next month and provide a brief presentation and overview, and that will give you a chance to review these, and we can have any questions at that time. Are there any other items from staff? Yes, sir.
Yeah, Mr. Chairman, I just want to point out that we do need an action on item number 3 to receive.
Oh, thank you very much for pointing that out.
Move we receive the report.
All in favor?
Aye.
Any opposed? Great. Thank you, Bob.
Mr. Chair, I just have one question on item 5.
I don't believe so. I think we had given direction there. Because I think we've left that on there as an open item that would give us the opportunity to make a decision if we chose to, and not if we don't need anything. I think that's the one we're going to keep on every meeting, right, regardless? Okay.
That was my goal, so that in any case,
Right, if we need to be able to respond, we can.
whatever agility we can get.
Right. All right. With no other items, then we are adjourned.
Good discussions.